In this chapter, we will address the issues associated with inventories. Basically, we will learn how to calculate the cost of goods sold. We will talk about how to account for inventories, and then we will also discuss the cost flow assumptions. And later on, we will also talk about the effect of inventory errors on the financial statements. So to start with, just to differentiate between merchandising companies and manufacturing companies, they both have inventory. The difference is that merchandising companies, they only have one kind of inventory, and this is the inventory that they purchased. This is already packaged goods that they purchased from their suppliers, and they sell it to their consumers or to their customers. On the other hand, manufacturing companies, they have basically three classifications of inventory. They have the raw materials, they have the work in progress, the work in process, as well as finished goods. So anyways, companies, they will report any kind of inventory they have under current assets on the balance sheet. Basically, merchandising companies, they in this chapter we'll focus on merchandising companies simply because it's simpler and it's just one kind of inventory. Plus, it is easier to basically to visualize. However, whatever we will talk about, whatever we will say about merchandising companies also applies to manufacturing companies. For manufacturing companies, raw materials are, for example, the company might have the raw. Let's take, for example, a car manufacturing company like Ford, for example. They would have raw materials that would include, for instance, steel. They would include the glass for the windshields, steel for the body. They would also include rubber for the tire, etc. Those are raw materials that they have not been used or processed yet. And then we also have finished goods. Those are the cars that the company is ready to sell, trucks that the company is ready to sell, etc. They are completed. And then you have whatever is in between. Those are work in process. Those are the cars or the trucks that are being manufactured now. And the level of each kind of inventory has its implications. So for example, if you have too much raw materials and not too much finished goods, management usually uses this information in order to decide whether to slow down the production. So for example, if they have a lot of raw material and very little finished goods, it means that maybe they need to speed up the production a little bit, and vice versa. There's also another kind of inventory that is called just-in-time inventory. This is one of the most famous companies who does that is Dell Computers. Dell, what it did was it linked their inventory system. Basically, it linked their accounting system to their suppliers' systems. At this point, let's say that you go online and you order a customized laptop. As soon as you order the customized laptop, each supplier of each part will be notified automatically, and then they will send the necessary part for Dell, who will assemble the laptop, and then they will send it to you. They will ship it to you. For example, if you request a processor that is Core i7, at that point, the processor's supplier will send the processor, that Core i7 processor to Dell, and then Dell will also receive from the hard drives. They will receive the part that you requested. They will put them all together, assemble the laptop, and ship it to you. Now, this has some advantages in that Dell at this point will not have to keep a high level of inventory, and this is especially has an advantage for industries where the value can get obsolete very quickly, like with the technology industry. Plus, if you have more inventory, you will also need more storage for that. So So that would be, it saves the company a lot of money by not having large amounts of inventory. Now, on the other hand, it will also have the risk of not being able to fulfill products if for any reason, let's say that for any reason the supplier fails to deliver the product that you asked for on time. What happens that Dell will not be able to assemble your laptop, and at that point it will either take longer or it will not be delivered at all. In case, for example, you cancel your order if you don't want to wait a long time. Now, this is not a big problem when it is just one customer, but imagine that this is happening for a business customer where they, let's say Rutgers, if they ordered like 100 computers from Dell, and then Dell, if they fail to deliver on time, Rutgers might cancel the contract. So this is why, well, it saves a lot of money in that they don't need to keep large numbers of inventory on hand. At the same time, if for any reason the suppliers do not deliver in time, the company might lose the opportunity of sales. They may run out of stock, etc. Another issue that might happen is that if for any reason the prices go up, the cost of this inventory will also increase. At that point, Dell will not be making as much money as before. For example, like last year there was an issue with hard drives, with manufacturing plants for hard drives, and the prices of hard drives increased as a result. That was in 2013. As a result, there were a lot of problems with delivering on time, as well as the cost had increased at that point. As you remember, in chapter 5 we talked about the two inventory systems that the company might have. We talked about perpetual systems as well as periodic systems, and we said that both the companies who use both systems will in fact conduct a physical count at the end of the accounting period, however for different reasons. Companies who use perpetual systems would conduct an inventory, a physical count of the inventory to make sure that there was no theft, to basically to see exactly how much they have in when they actually calculate count how much they actually have on hand. They will know how much waste raw material they had. They would know, for example, if employees stole anything, if there was any damaged material. At the same time, they will also check for accuracy for inventory, for their inventory balances, and that would give them an idea if there was any fraud or anything like that. However, the company does not need to conduct a physical count. They do it from a control and monitoring perspective, rather than to calculate the cost of goods sold, because the cost of goods sold is calculated after every sales transaction under the perpetual system. Under the periodic system, the company would conduct a physical inventory count because they need to determine the value of the inventory on hand as well, and then to calculate the cost of goods sold for that accounting period. Now, the physical inventory count is taken usually on a day where the business is slow or when the business is closed, because it takes a long time. And what happens is that in order to take the physical count, basically what you're doing, you actually count each and every item you have in your inventory. Certain items are sold by weight. At that point, you will also need to weigh each item separately and record that information. And this is why this is only done at the end of the accounting period, and usually it's done on a slow day. Another thing that needs to be taken into consideration is the ownership of goods. Who owns those goods in transit? So basically this is for the goods in transit. As you remember, we talked about that before. Those are the goods that the company has either sold, the company either sold but did not deliver yet, or the company purchased but they have not received them yet. Either way, it depends on the legal title. It depends on the the party who owns them during the shipping will basically need to include them in their inventory. So goods in transit should be included in the inventory of the buyer when the public carrier accepts the goods from the seller, when the goods reach the buyer, when the terms of sale are FOB destination, or when the terms of sale are FOB shipping point. Because it is the buyer who will be, when you say that the goods in transit should be included in the inventory of the buyer, it means that they should be at that point owned by the buyer. And as you remember, we said that it depends on who pays the shipping. At this point, if the buyer is to include them in their inventory, it means that the buyer paid for the shipping, which is to mean it is terms of sale were FOB or free on board shipping point, because the seller at that point will not pay for them. If the seller paid for them, they would include them in their inventory. If the seller paid for the shipping, I mean. So this is, as you remember, the goods in transit. This is where ownership passes. It's at this point. When the shipping terms are FOB shipping point, the buyer will be paying for the shipping. At that point, it becomes the buyer's ownership. As soon as the ownership passes to the buyer as soon as the delivery truck receives them. So at this point here, it will be at this point here. But if the terms of sale are FOB destination, it means that the seller will pay for the shipping, and at that point, it's only when it is when the products are delivered to the buyer that ownership passes to the buyer. So when it is FOB shipping point, this part here, it will be recorded on the buyer's inventory. When it is FOB destination, it will be added to the seller's inventory. Now, there's also another kind of ownership that is called ownership of that is called consigned goods. But, well, this is the goods that company might sell for a third party. At this point, the ownership is still for the third party. Take, for example, if you intend to sell your car, you will take the car to a used car dealer, and you ask them to sell it for you. They will keep it in their lot, in their showroom. They will sell it for you for a fee, but they will not buy it from you. So you are still the owner of that car, and the dealer will be just selling it for you. So this is what we mean by consigned goods. So once we have determined the quantity of inventory that we have on hand, this is the ending inventory, we need to calculate basically the cost of goods sold. This is the value of the inventory that was sold. But what's the problem here? The problem is that so far we have been considering that the value or the cost of the inventory was the same for all the different units that the company purchased. But in reality, this is seldom the case. Most of the time, companies, they will buy their inventory at different in different times and at different prices. As a result, it is very important to know which unit cost we will apply to the sold inventory in order to calculate the cost of goods sold. There are several ways of doing that. The first one here that we can see, this is the specific identification. This is mostly when you know exactly which item you sold. So at this point, for example, think that you have, for instance, a TV or a car. You can always know exactly the cost that was associated with manufacturing a car simply by looking up the VIN number. This is why we call specific identification. If this information is not available, or in many cases it's not worth it's not worth the trouble of tracking the exact cost. For example, let's say that you're trying to you're selling pencils or erasers. You're not going to try and look up this serial number for each one of them. It's not that important. At that point, companies, they use cost flow assumptions. So here they are assuming that the flow of goods, the physical flow of goods, is FIFO, which is first in, first out. That means the first products that the company purchased first will be sold first. Basically, you get rid of your earliest purchases first, or last in, first out. This is basically the latest purchases will be sold first, or the average cost. And we'll talk about each one of them separately. So, for example, let's take this example. Assume that Crevets TV company purchases 3 identical TVs. So we have TV 1, TV 2, and TV 3 that were purchased at different dates, and as a result they were also purchased at different prices. So during the year, the company sold 2 TV sets for $1,200 each. Now this is the selling price. Keep in mind that the selling price is not involved in involved in calculating the cost of goods sold. It's the purchase price that is involved in the cost of goods sold. This is the cost of inventory. Those are also the cost of inventory. Now, the company sold 2 TVs. The problem is that which 2 TVs are we going to which TVs were sold? The reason we need to know that is we are going to allocate the cost of these 2 TVs in order to match the revenues from those 2 TVs. So we know that the revenues were $1,200 times 2. So those are the revenues. But what about the cost of goods sold, that the expense that was associated with selling those TVs? Did we sell TV 1 and TV 3? Or was it TV 1 and TV 2? Or TV 1 and TV 2 and TV 3? So which ones did we actually sell? If we are using the specific identification method, so this is the question, because the cost will be different. If it was TV 1 and TV 2, it will be $1,500. The cost of goods sold will be $1,500. If it was TV 1 and TV 2, it will be $1,450. If it was TV 2 and TV 3, it will be $1,550. So which one is the correct? Now, if we are using the specific identification, this is efficient when you have high value items. At this point, you know that this TV, you look at the serial number of the TV and you know exactly when how much it costs you to acquire that, to acquire that TV. So let's say that using the specific identification, you looked at the serial numbers and you know that TVs 1 and TV 3 were sold. So the cost of goods sold will be equal to 700 plus 800. So this is the 800 and this is the 700. So we know that the cost of goods sold will be equal to 1,500. The value of our ending inventory will be 750. So this is basically using the specific identification. And like we mentioned, this is the actual physical flow of goods. This is exactly how the products are being sold. So we know that TV 1 was sold, and then TV 3 was sold. TV 2 was not, was still in our storage. However, like we said, this is not used very widely because it is high. The cost is high. It's not easy to keep track of this, although computerized systems are making this more and more possible, but still the cost is too high, and in many cases companies, they will find it a lot easier to just make assumptions using FIFO, LIFO, or the average cost. And in fact, very few companies who use methods other than these three major cost flow three cost flow assumptions. So we have almost half the companies that use first in, first out, mostly because it is the closest after this specific identification. It is the closest to the physical flow of goods. And then you have LIFO, which is 27%, and the average cost is used by 22% of the companies. As we mentioned, most companies will be using the assumption cost flow assumptions. So let's take this example and work it out for the three types of cost flow for the three methods. This data is for Houston Electronics Astro condensers. We have the beginning inventory. This is the beginning inventory, and then we have three purchases at three different times and three different unit costs. That would give us the total units available for sale. Up to this number, until this number, the information will always be the same, no matter what method the company uses. Well, this is simply because you have the beginning inventory from last year's balance sheet, from the end of last year's balance sheet, basically, and then the purchases, you can get these numbers from your purchase invoices. So that would give you the total number of units available and the total cost of these units that are available for sale. This is whatever you have. This is whatever you have in your inventory, whatever you started with, and then what you purchased during that accounting period. So the beginning inventory plus purchases, this is also called the cost of goods available for sale. At the end, you have minus ending inventory will give you the cost of goods sold. Basically what we're saying here is that the inventory that we had, and then that we had at the beginning of the year, plus whatever we purchased, we ended up with 1,000 units. These 1,000 units, we will sell part of them, that would be the cost of goods sold, and then we will end up with 400. So we'll end up also with another part that will be in our ending inventory. So basically, this is the part that you sold, and this is the part that was not sold. So this is the part that was sold, and this is the part that was not sold. Now let's start applying the three methods together. However, this is very important. This is very important, and you'll see that most of the problems we can solve them starting with this equation. So we will start with first in, first out. And here the assumption is that the earliest goods will be the earliest goods that you purchased will be sold first. So and this is usually a good practice, because in real life companies, they try to get rid of their oldest merchandise first. This does not really mean that they were actually, this is what they actually happened. This is that the company actually sold the earliest purchases first. But this is the assumption, especially that it parallels the actual physical flow that is the general practice of companies. Now, in order to calculate the cost of goods sold, it is always a good practice, and it is always the best way to do is to calculate the value of the ending inventory and subtract it from the cost of goods available for sale. So you always calculate the ending inventory, and then we calculate the cost of goods sold. Let's look at this example here. So like we mentioned here, until this part here, it does not change whether it was FIFO, LIFO, or average cost or whatever. This is the same information that we have. We have the beginning inventory plus purchases, and we have that would give us the total number of units and the total cost. When we are talking about FIFO, we're talking about first in, first out. That means the first items that we purchased, so those were the ones that we purchased, we will sell them first. So this is cost of goods sold. So those are the units that were sold. You start selling the earliest ones and then you move forward. Which also means that for the ending inventory, our ending inventory will be, you expect to be left with the latest. So what we expect to have is we expect to be left with the latest ones, and then you go backward. Ending inventory. Think about it this way. We had here a bucket. So let's say that we had here 4 buckets. One of them is for 100, that was 100 units, and the cost of each one was 10. Then we also had another bucket or another box with 200 units that we purchased for 11. We also had 300 units for the value of 12. And finally, we have 400 units that were purchased for the price of 13 units each. Here, the company, according to the physical inventory, when we took the physical inventory, the company found that they have ending inventory 450 units. So we know that at that point, we know that the company has sold 400, the company actually sold 1000 minus 450. So the company sold 1000 minus 500 or minus 450, which is equal to 550 units. Ending inventory is equal to 450 units. So because you are selling the earliest purchases first, you expect the latest purchases to remain till the end. So the ending inventory, we will start from this one here. For the ending inventory, basically you need 450. So you take those 400. So we take those 400 and we still need 50. We take 50 from this bucket. So here we took 400 and 50. So to calculate the ending inventory, you have 400 multiplied. Have 400 multiplied by 13. This is from this bucket, and then we have 50 multiplied by 12 from this one here. That would give us the value of the ending inventory. To calculate the cost of goods sold, you subtract this number from the total cost of units. So this is the cost of goods available for sale. This will give you the cost of goods sold. Now, if you are asked in a homework or something to verify your information, at that point, you calculate the cost of goods sold directly without calculating the ending inventory first. How do we do that? Once again, let's look at this one here. We have 550 that we needed to use, so we used the 100 here, 200, and then we also sold 250 from this one. So we sold also 250. As a result, we would have 100 multiplied by 10 plus 200 multiplied by 11 plus 250 multiplied by 12. That would give us 6,200. This is the same. This is the cost of goods sold. This is when you are asked to calculate it. But whenever you are asked to calculate the cost of goods sold, always calculate the ending inventory first and then subtract it from the cost of goods available for sale. This is basically what you're saying, that you had a total value for the whole inventory. We had $12,000. The cost of goods available was equal to $12,000. We sold 6,200, and the ending inventory was 5,800 that were remaining in our warehouse. Now LIFO is the other way around. When we use last in first out, the company is assuming basically that the latest purchases will be sold first. This is rarely the case in real life, except for products that pile up, such as, for example, sand or salt. When you sell them in, like with trucks, in order to, let's say, sell a truck of sand, you're not going to dig deep inside the whole pile just to get the oldest sand first. At that point, you just take whatever is on top. Here, because we are selling the latest purchases first, we expect the ending inventory to be the earliest purchases. So at this point, you're selling the latest ones first, and you end up with the ending inventory will be the earliest purchases first. As a result, when you are selling, so we are selling the latest ones, and then we go backward. Those are the sold ones, which is to mean ending inventory will be the other way around. You start to calculate the ending inventory from the earliest ones, and then you move forward. This is the same example. So we have 450 units. Again, we have the 5 buckets. 4 buckets, sorry. We have 100 for 10, we have 200 for 11, we have 300 for 12, and we have 400 that were purchased at 13. So the cost of goods sold, you would start from the ending and you go backwards, but in this case we need to calculate the ending inventory. So at this point we have 450. So we start with this is 100 times 10. So this is the ending inventory. And then we have 200 times 11. We still need 150. So from this one we take 150. It would be 150 multiplied by 12. And that would be the ending inventory. The value of our ending inventory is 5,000 under LIFO. It was 5,800 under FIFO. Now it is 5,000 under LIFO. To calculate the cost of goods sold, once again we subtract the ending inventory from the cost of goods sold, and that from the cost of goods available for sale. That would give us the cost of goods sold. In order to verify the information, we can do it the other way around here. So first we need 550. So the cost of goods sold will be for 500. We've sold 550 units. It will be 400. So it will be in this case 400 multiplied by 13 plus 150 multiplied by 12, and that would give us the same number, 7,000. This is the part that will remain in our warehouse. This is the part that was sold. For the average cost, It's very simpler. We take the weighted average for all the units, and then we multiply it by the number of units that are still on hand to calculate the ending inventory, or we multiply by the number of units that were sold to calculate the cost of goods sold. In order to calculate the weighted average unit, we divide the cost of goods available for sale by the total number of units available for sale. For example, in this case, in order to calculate we divide the total cost of goods available for sale, we divide it by the number of units available for sale. So in this case, it is $12 per unit. If you don't have the totals, it's simple. You do the same thing as we did here. It will be you will have to multiply 100 by 10, then 200 by 11, 300 by 12, 400 by 13. You add them up and you divide them by the total number. That will give you the cost of goods available, and then you divide it by the number of units available. Now that we have the price or the cost, now that we have the cost at this point, remember that this is not the selling price. This is the cost to the company, the purchase price. So now that we have the cost on average is $12, we multiply it by the number of units that is in our ending inventory. So this would be the value of our ending inventory. We subtract it from the cost of goods available for sale, and that would give us the cost of goods sold. Here we're saying that it doesn't matter which unit we are selling, we are taking the average of all these units, and then we multiply it by the number of units that are in our warehouse to give us the ending inventory, and then we can also calculate at that time the cost of goods sold. So this is a typical question that you can get in the exam. Graham Company uses a periodic inventory system. Details for the inventory account for the month of January 2011 are as follows. So the balance at the beginning of this would be the beginning inventory. So this is the beginning inventory. At the end of the month, inventory showed that 180 units were on hand. So the number of units in our ending inventory is 180 units. If the company uses LIFO, what is the value of the ending inventory? Because we are using LIFO, we are selling the latest ones first. So this is the ones that are sold, just to mean the ending inventory will be the earliest purchases forward. Okay, so to calculate the ending inventory, we have to multiply the number of units that we start from the earliest purchases and we move forward. So the ending inventory will be equal to 180 multiplied by 5, which is equal to $900. And this is because the first purchase or the first batch of units had the number that we have. If the question had asked you about the cost of goods sold, you would subtract this number here from the cost of goods available for sale. Now, Rudolph Diesel Company's inventory records show the following data. Now we have, this is the beginning inventory, and those are the purchases. We have two purchases. The physical inventory on December 31st shows 8,000 units on hand. Whenever you hear the words 8 on hand, this means ending inventory. So the ending inventory is 8,000 units. So this is the ending inventory. How do we calculate under FIFO? Again, we are selling the first items first. So those are the items sold like that, then which means that the ending inventory will be from the latest purchases and you move backwards. We have 8,000 units, so we can take 6,000 from the first box, which was purchased at $7 per unit. That would be 42,000, and we use this one. I will still have 2,000, just to mean the 2,000 will be taken from the next, from the purchase before that, which was 8. That would be 16,000, and that was like we saw, it was taken from the second one. The total will be 58,000. This is how you calculate the inventory. Once again, to calculate the cost of goods sold, subtract it from the cost of goods available for sale. Now for the average cost, here the question is asking us to calculate the average unit for inventory. How do we calculate that? We need to calculate the total cost of goods available for sale, and we divide it by the total number of units available for sale. In this case, it is 200 multiplied by 10 plus 300 multiplied by 12, which would equal to 2,000 plus 3,600. It's 5,600. We have number of units is equal to 500. This is 200 plus 300. So the average, the weighted average will be equal to 5,600 divided by 500. That would be 11.20. That would be 11.20 per unit on average. Now, in order to calculate the cost of goods sold, the company sold 250 units. You can either multiply it directly by 1120, or at that point you can also calculate the ending inventory will be equal to the total units minus the one sold, which is equal to 250 multiplied by 1120. And then you subtract this amount from, then you subtract this amount here from 5,600. Companies have the right to choose which method, which cost flow method they would be using, whether they will choose to use FIFO, LIFO, or average cost. And this depends on several factors that the company management will take into consideration. One of these factors is the effect on the income statement. As you remember, because of the changes in the ending inventory balance and the cost of goods sold, the net income will be different depending on the method that the company uses. So if the company uses FIFO, as we can see here, FIFO usually leads to the highest ending inventory balance. This is in the case of rising prices. So in the case of inflation, when the prices are rising, FIFO will give the highest net income. So the company will give the highest net income, and at the same time, the company will have the lowest cost of goods sold. And this makes sense because at this point you're saying that you have the same sales revenue. As you can see, sales revenues, they don't change, but you're saying that under FIFO you have less expenses because cost of goods sold, which is an expense, it is lowest under FIFO in the whenever we have an inflation or in the case of rising prices. Now, LIFO is the other way around. LIFO has the highest cost of goods sold. As a result, it will have the lowest, this is the lowest net income. So companies, in general, they try to boost their net income and to show that they have let's say the highest possible net income for several reasons. One of them is, for example, that management in many cases is performance based. Management compensation is performance based, which means that the better the company is doing, the higher the compensation of management. So this is why they try to get the highest net income and to use the highest net income. Like we said, this is there's here an advantage of LIFO if the company decides to be more conservative, in that if the company uses FIFO, the problem would be is that when the company later on tries to replenish their inventory or replace their inventory, the replacement price will be most likely similar to the replacement price will be most likely similar to the latest purchases, which is to mean that they will have to take part of this net income in order to be able to replace their inventory. So in order to be more conservative, LIFO would be more conservative because they are not overstating their assets or net income at this point. Now we also have the balance sheet effect. This is, as you remember, there are two accounts that are involved in depending on the method that is used. Those are the ending inventory and the cost of goods sold. The cost of goods sold is an expense, so it will affect the income statement. Ending inventory is a balance sheet element, and it will affect the balance sheet. And here, in this case, the ending inventory under FIFO, using FIFO to estimate the ending inventory has an advantage whenever there's an inflation, in that the balance in the ending inventory will be the closest to the actual replacement cost that the company will have, for example, to pay in order to replace the sold inventory, as opposed to LIFO, where their ending inventory may be understated because they are in the case of inflation, because it will approximate the earliest purchases. For example, in the book there's an example given about Caterpillar, where their ending inventory, where they use LIFO, and their ending inventory is around $5 or $6 billion. And however, if they use FIFO, it will go up to around $9 billion. However, why do you think that that companies then at that point they don't immediately switch to FIFO? Well, we get to the third effect, and that is tax effect. So why do companies select LIFO even during inflation? The reason is that companies, they don't like to pay income taxes, and income taxes are the lowest when the net income itself is the lowest. And as you remember from the table before, the income will be the lowest in under if we use LIFO during an inflation or during rising prices. This is why companies sometimes, like for example Caterpillar, they may not want to switch to FIFO because they will have to pay additional taxes, and rather than doing that, management may decide to keep the cash in the company and keep reporting using LIFO. So the companies are supposed to be consistent. In order, this is the consistency principle. They are expected to keep reporting and using the same method to allow users of this information, like potential investors, creditors, etc., to be able to compare the company's performance over time, basically to compare this year's net income to last year's. And however, this does not mean that the companies, they don't have the right to switch at all. They have the right to switch. However, whenever they do make a switch, they will have to disclose this information, as well as how this will affect the net income, and they usually disclose that in the notes. So as you can see here, the the company adopted LIFO. Basically, they switched to LIFO, and they say that LIFO, they give the reason why that they made this change, as well as the effect on net income. Basically, the effect that will have the effect of switching to LIFO compared to the previous method. Now, in certain cases, the companies, the inventory, the value of the inventory will be much lower than its cost, than its original cost. As we remember, usually inventory is an asset, and it has to be recorded according to the cost principle. It has to be recorded at the cost of acquiring that asset. But in certain cases, companies, they can write down the inventory that they have if the market price or the market value drops permanently. Take, for example, precious metals, or if let's give an example. For example, let's say that Best Buy, they still have Pentium 3 computers, and when they purchased them originally, each one of them would cost $600 to Best Buy. So the cost was $600, but it does not make any sense that Best Buy keeps making this keep reporting this inventory at cost at $600, because now you can get it at now no one will basically buy it for that amount. So the purchase cost dropped, and it also has affected the selling price as well. Here, when we talk about the market value, we're talking about the price or the cost of replacing the inventory today. So if Best Buy tries to replace the inventory today, it will be a lot less than that. And in order to be more conservative, this is the conservatism principle. Basically, in order to be more conservative, companies, they try to stick to the option that would least overstate net income and assets. As a result, sometimes the companies, they have to report their inventory based on the lower of cost or market. So if the cost of replacing the inventory which is the market, so the cost of replacing the inventory, if it is lower than the purchase cost, than the original cost of acquiring it, the company will report it according to the market value. Let's take this example here. Assume that Kentucky TV has the following lines of merchandise with cost and market values as indicated. So in the first one, we'll look at flat screen TVs. The cost, the original cost at which the company acquired those TVs was $60,000, whereas the market is $55,000. Now this is the market in order if the company is going to replace their inventory now. So that usually means that, for example, let's say that this is a 5-year-old TV or 10-year-old TV. If the company is going to purchase them again now, most probably it will be cheaper, and this would be also drive the selling price as well. Under LCM, lower of cost or market, LCM, company will report this at market in this case. Now for satellite radios, the cost is lower than the market, so cost is used. DVD recorders will use market, DVDs we're using market, so the total inventory will be lower than it is actually. And there are several ways of doing that. Certain companies, they just total the cost and total market, so basically you can total this one and total this one and see which one is lower, and then they use it. So there are several ways of doing that. Now, unfortunately, there are, in several cases, inventory errors occur, and this could be simply for human error. Someone miscounted the inventory correctly, It could be someone who did not take into consideration the goods in transit, and this usually affects both the income statement and the balance sheet. And why is that? Because the ending inventory, when we count inventory, actually we're counting the ending inventory, and whenever we count there's an error with the ending inventory, it will affect both ending inventory as well as the cost of goods sold, which is to mean it will affect the balance sheet and the income statement at the same time. So the income statement, whenever we are dealing with the beginning with calculating the cost of goods sold or looking at the net income and how it will be affected, we need to start with this equation. So basically we have the beginning inventory plus the cost of goods purchased, and by the way, the two together are the cost of goods available for sale. If we subtract the ending inventory from that, the cost of goods sold, we will get to the cost of goods sold. Now let's say that the beginning inventory was understated. So if the beginning inventory was understated, the cost of goods sold will also be understated. So the cost of goods, we will say here that we have less cost of goods available for sale, so we have less cost of goods sold. So if beginning inventory is understated, the cost of goods sold will also be understated. And when we're saying that the cost of goods sold is understated, that means we are understating our expenses. At this point, we will be overstating net income. On the other hand, if we overstate beginning inventory, we will be overstating the cost of goods sold, and at this point we are overstating our expenses, so our net income will be understated. Let's look at the examples here. So here, this is the correct number, this is the wrong number. So at this point we're saying that this one and this one would have been those are the correct ones. So when we understated beginning inventory, we have actually understated the cost of goods sold, and vice versa. When we have overstated beginning inventory, I'm sorry, here it was beginning inventory. So when we have overstated beginning inventory, this is beginning inventory and this is beginning inventory, we have also overstated the cost of goods sold. As a result, we would understate our net income. Now, we also need to look at the ending inventory. The ending inventory, when it is overstated, the cost of goods sold will be understated. See here, when this one was, this is the ending inventory, when it is overstated, we can see that the cost of goods sold is understated. And this makes sense because the two of them, they are basically competing over the same thing, which is the cost of goods available for sale. So let's say that we have this part here is the cost of so this is the cost of goods available for sale. Let's say that for example this was the ending inventory. That would automatically be the cost of goods sold. Now let's say that this would be the ending inventory at this point. The remaining part will be less. And the other, it's also again the other way around. This is if we have ending inventory is understated, the cost of goods sold will be overstated, and net income will be overstated as well, because net income will be understated, because at this point we will say that the net income, which is revenues minus expenses, we are overstating our expenses, which means that we have, and this is the case here, when we understate ending inventory, we are overstating our expenses, and at that point it means that we are understating our net income. Now, we said before that the error in inventories usually happens because of the let's say failure in counting, etc. Basically, it's failure in evaluating the ending inventory. Then why do we have here beginning inventory? Well, the reason behind that is that the ending inventory of 2012 will automatically be the beginning inventory for 2013. So basically, the ending inventory in this accounting period will be the beginning inventory in the next accounting period. So the error in the ending inventory in this accounting period will be carried over, might be carried over to the beginning inventory. It will be carried over to the beginning inventory in the next accounting period. So as we saw, an inventory error will affect the income statement because it is affecting the cost of goods sold, and consequently it will affect the net income. And because it is affecting the cost of goods sold, and because it's affecting the ending inventory from this accounting period, which will also be it will also affect the next accounting period. So basically, any inventory error will have an effect on 2 accounting periods. And basically, the effect in accounting period 1 will be offset by the effect on the second accounting period. So if we look at the net income from the 2 accounting periods together, it will be accurate. Now, the ending inventory from the second accounting period will not depend on any inventory errors now, simply because it will depend on the new physical count of the inventory. So let's look at this one more closely. As we mentioned before, usually until the cost of goods sold, the numbers will be the same, because at this point you have the beginning inventory, and here we are assuming that the beginning inventory was correct, because here we're only talking in this case about the ending inventory. So here we are only talking about the ending inventory. So at this point we are talking about the ending inventory here. So cost of goods sold will be simply the beginning inventory plus purchases, which the information of which we can look at from the purchases, from the invoices, etc. So ending inventory here, it was understated. This is the correct one. This is the incorrect one. This is correct. This is incorrect. So this is accounting period 1. This is accounting period 1. This is accounting period 2. So in this case, ending inventory was understated. This was understated, which is to mean the cost of goods sold here was overstated. Remember that the sum of the 2 numbers must be equal to the cost of goods available for sale. So if one of them was understated, the second will be overstated. And here also, as we can see, the 2 of them together will be equal to the cost of goods available for sale. Looking at this one, we see that the net income was understated. So the net income was understated by 3,000. It was here understated by 3,000 in the first year. Now this ending inventory becomes the beginning inventory of the next accounting period. Here, as you can see, because it is in the beginning accounting period, there will also be an error in the cost of goods available for sale. The ending inventory here, we assume the new physical count is correct for 2014. This is end of 2014. At the end of 2014, we conducted a correct physical count. This is the assumption here. Now, because the beginning inventory is understated, we see that the cost of goods sold will also be understated. Here we have the net income will be overstated by 3,000. So the effect of the 2 years together, this one will offset the previous understatement. And to see that, let's look at those two here. So if we look at 22, we add 22 to 13. This is from year 1 and year 2. So we have 22,000 plus 13,000. This is 35,000. And now we also look at this one and this one. Those are the correct ones. So if we add the correct ones and if we add the incorrect ones, the totals will be the same. Again, we have 25,000 plus 10,000, it's 35,000. This one is equal to this one. As we can see, here we have, for the 2 years, the net income will be correct if we combine the 2 years together. So it has those effects on, so an inventory error will have this effect on the income statement and net income. It will also has an effect on the balance sheet because it will affect the balance in the inventory account. So let's say that the ending inventory, at this point, the ending inventory, if it was overstated, so this one, if ending inventory is overstated, you're claiming you have more assets, so your assets are overstated. Liabilities will not change because it has nothing to do with the liability. But stockholders' equity will be overstated. So if this one is overstated, this one has no effect. This one will also have to be overstated. And if this one is understated, this one again will not change and this one will be understated. This is an example just as a reminder of LCM and inventory errors. Those two questions. So the first one is which one to choose, whether it is, or we need to choose the which one to choose. Is it the cost or market? So the first one, gas, the cost is 84,000, market is 79,000. The lowest is market, so we pick market. Wood, cost is 250, market is 280, so we pick cost. Pellet, it's 112 for cost, and market is it is at 101, so we pick market. And at this point, the total inventory on the LCM will be 430,000. So here we look at inventory errors. Visual Company overstated its 2013 ending inventory by 22,000. We need to determine the impact that this one has on the ending inventory, cost of goods sold, and stockholders' equity in both years, 2013 and the subsequent accounting period, which is 2014. Okay, so we said that the ending inventory was in 2013 was overstated by 2013. And what happens in 2014? Well, the ending inventory in 2014 will not be affected. As you remember, the ending inventory in 2014 will not be affected by the error that was done by the ending inventory in 2013. 2014, the ending inventory will depend on the accuracy of the physical count that is conducted at the end of 2014. So assuming that there were no other additional errors, 2014 will be correct, and the ending inventory of 2014 will be correct. So this simply says that the ending inventory error from 2013 has no effect on the ending inventory in 2014. The cost of goods sold, because in 2013, because the ending inventory was overstated. The cost of goods sold in 2013 will be understated, but in 2014 it will be overstated. If you remember, the ending inventory in 2013 will become the beginning inventory in 2014, which will have this effect because it will be overstated. So the cost of goods sold will also be overstated in 2014. Stockholders' equity, it will be overstated in 2013, but it has no effect in 2014. Again, because the ending inventory in 2014 will not be affected. So inventory is presented on the balance sheet. So it is presented on the balance sheet as current assets, and the companies, they have to disclose basically what kind of inventory they have. Is it just is it raw material, finished goods, etc. Inventory that, so they have to disclose the major inventory classifications. So basically they have to disclose the major inventory classifications. Of course, what cost flow method, what costing method they are using. Is it FIFO, LIFO, average cost, etc. They also need to disclose whether they use LCM or cost. The income statement is cost of goods sold will be subtracted from net sales, and that would be under the this is under the classified under the multiple step income statement. It would be subtracted right from the sales to get to gross profit. Learning more about the inventory is important, both to management as well as other people. So if you have a high level of inventory, that means probably, maybe for example, that you're not selling as much. It will have a cost on having to store more items in your warehouses, which is to mean you might need to have additional warehouses. All this will cause additional cost to the company. Plus, this inventory might become obsolete with time. So let's say that if you are having a high number of computers, as we know, technology lose value. Most of the time they lose value pretty quickly, especially when there's a new model that comes up. So this is what we mean by obsolescence. Or let's say if we're talking about fashion, last year's fashion will become obsolete this year in a way, or it will lose a lot of value. Also, high levels of inventory might cause additional suffer from additional damages, which all this will add to the cost of inventory. As a result, the company would not want to have high levels of inventory, but at the same time they don't want to have low levels of inventory. If they do have low levels of inventory, they might run out of stock, and at that point they might lose their customers to other companies who do have this item. So for example, let's say you're looking to buy a TV, you go to Best Buy, and Best Buy is running out of that item, but Walmart, they have it. Most likely you will not wait for Best Buy to order it and bring it, especially if it was at the same price. You will simply go to Walmart and buy it from there. So at this point they will be losing sales. This is why it is very important to analyze the level of inventory that you have in order to have the right amount of inventory in your warehouses. And usually there are two measurements or two measures that companies use. They use inventory turnover and the days in inventory. The inventory turnover gives the idea, tells us how many times the company sold their inventory. Whereas the days in inventory, it tells us how many days it takes for the company to sell its inventory. And to calculate the inventory turnover, we divide the cost of goods sold by the average inventory. Average inventory is simply the beginning inventory plus ending inventory divided by 2. Now, days in inventory also We divide, to calculate the days in inventory, we divide the days in the year, which is like 365, by the inventory turnover. So let's look at this example. Walmart reported in its 2011 annual report a beginning inventory of 32,713 million, an ending inventory of 36,318 million, and a cost of goods sold for the year ended January 31st. It was for 315,287 million. We need to calculate the inventory turnover and later on the days in inventory. So the cost of goods sold at this point is 315. And as you remember, we mentioned before that it is always a good practice in order to calculate the cost of goods sold. We usually allocate the cost for the ending inventory and we subtract it from the cost of goods available for sale. Well, simply because we expect the cost of goods sold to be much higher than the ending inventory. So the cost of goods sold is 315,287. We divide it by the average inventory. The average inventory will be beginning inventory plus ending inventory over 2. And that would give us the inventory turnover. What this means is that Walmart sold its inventory 9.13 times during 2011. If we divide 365 by 9.13, we get 40 days, and that simply means that it takes approximately 40 days for Walmart to sell its inventory. This is a typical exercise where you are asked to calculate the amount of ending inventory. So Baylor Inc. has a gross profit rate of 45%. During the year, the company had net sales of 400,000, goods available for sale of 260,000, and beginning inventory of 35,000. We need to calculate or compute the ending inventory. Whenever you are asked to answer a question like that, it's a good idea to start from the beginning with this equation. We know that beginning inventory plus purchases minus cost of goods sold is equal to ending inventory. In this example here, we have, and remember that those two here, they are the cost of goods available for sale. We do have this one. This is the 260,000. But we don't have the cost of goods sold. How do you calculate the cost of goods sold? So the cost of goods sold, we can get it from the gross profit, which is equal to net sales minus cost of goods sold, which means that the cost of goods sold is equal to net sales minus gross profit. We have net sales, we need to calculate the gross profit. At this point, we have gross profit rate, which is given to us as 45%. It's equal to gross profit divided by net sales. So the gross profit will be equal to net sales multiplied by gross profit rate, which is equal to net sales was 400,000 multiplied by 45%. That would be equal to 180,000. which means here, if we have here 180,000, now we take this one here, cost of goods sold is equal to net sales minus gross profit, which is equal to 400,000 minus 180,000. That would be equal to 220,000. Again, we plug this one number here, which would give us the ending inventory is equal to 260,000. This is the cost of goods available for sale minus 220, which is the cost of goods sold. That would be 40,000. And this is this answer would be D. So if you have a question like that, just make sure to start from the beginning, and then just look for the numbers that you have. At this point, we did not use this item here. Beginning inventory, we did not need to use it, but if we had, rather than, because in this case they gave us the goods available for sale, but let's say that they give us purchases, at that point we would use beginning inventory plus purchases. So this type of questions will depend on what information they give you and what they are asking you to do.